All right, let's dive right into this explainer by confronting a massive assumption. It's an assumption almost everyone gets completely wrong about European financial history. We all think we know exactly how Europe united, but as you'll see, the facts tell a completely different story.
Think about it. Did the euro actually unite Europe's markets? Was that shiny new currency the magic bullet we all thought it was? Did it finally bring all those stubbornly different economies together? The answer is absolutely going to shock you. Well, here is your face-slapping reality check. The myth is that the euro integrated European markets. The globally accepted common sense? It's completely wrong, and the data proves it. Standard European Union membership actually did all the heavy lifting. The currency itself, barely a blip.
Section 1. The Great Euro Myth, Shattering the Single Currency Illusion.
Look, we all assumed a shared currency changed everything, right? I mean, that's the narrative we've literally been fed for decades. But spoiler alert, we were wrong. A deep dive into the data from 1990 to 2007 tells a totally different, entirely counterintuitive story.
Let's move to Section 2, the true measuring stick, how to measure integration.
So how do you actually measure integration without falling into the trap of chaotic, volatile stock market returns? Well, this groundbreaking realization comes from a rigorous 2013 study published in the highly respected Journal of Financial Economics. The authors looked through a completely different, highly revealing lens.
And their method is brilliantly simple. Step 1, find similar industries. Step 2, look at their valuations. Step 3, measure the price gap. That's it. Instead of tying ourselves up in knots with complex academic models, we're just comparing the price tags, specifically the earnings yields, of similar companies across borders. It's simple, it's genius.
So, the whole idea hinges on this one crucial point. If markets are truly merging, their valuations absolutely must converge. A tech company in Germany and a tech company in France should eventually have the exact same valuation. Segmented markets have wildly different price tags, but integrated markets, they look identical. And we aren't dealing with academic jargon here. We are talking hard, undeniable data. The researchers crunched the numbers from 33 countries. They looked at 38 different industries. They analyzed the baseline data of literally thousands of firms. Why? Because they wanted to find out what actually pulled them together.
Which brings us to Section 3, the secret EU power, the real hero of integration.
This builds into the most surprising discovery of the entire research paper. Just look at this massive 150 basis points drop. Standard European Union membership slashed the valuation differences between countries, not the currency. Just being in the EU closed the gap, bringing European markets much closer to the highly integrated US benchmark.
Just follow the timeline here. Back in 1990, markets were deeply divided. By 1993, capital started moving freely. And by the year 2000, EU countries were already converging rapidly, long before the euro could even take full credit. By 2007, EU valuations nearly mirrored the integrated US market.
So here is the secret sauce. Joining the EU did two massive things. First, it drastically lowered the cost of raising money. We're talking a huge 3.6 to 4.3% drop. Second, it significantly boosted expected earnings growth. Now that is real economic and financial integration at work.
Section 4. The euro does nothing. The ultimate plot twist.
Okay, but you are probably asking yourself right now, what about the almighty euro? Didn't that do anything? What happened when countries finally adopted it? Well, brace yourselves. We are about to drop the hardest statistical truth of this whole explainer.
Zero, absolutely zero. The statistical impact of adopting the euro currency on equity market integration was exactly zero. It was completely insignificant. The data is absolutely crystal clear on this. The euro did not integrate these markets. And here is the punchline. The currency was just a bystander. The euro gets all the glory in the history books, right? But the boring underlying treaties did the real work. The rules harmonizing trade and capital markets were the actual heroes here. That new money in your pocket, it was just a symbol.
Section 5. Why this matters. The reality check for investors.
Let's bring this home and explain exactly why this historical plot twist matters for us today. This study is brilliant, proving that tracking stable valuations is infinitely better than tracking chaotic daily stock returns. Now, to be totally objective, it does have limitations. It's really hard to perfectly separate the EU effects from that massive global integration boom of the 1990s. But even so, the isolated EU effect stands incredibly strong in the data. So, the big takeaway? Don't be blinded by shiny new currencies. You've got to look at the underlying plumbing. Deep economic integration comes from tearing down invisible regulatory walls. It comes from shared rules. It absolutely does not come from just printing new money.
So I'm going to leave you with this incredibly provocative thought. If a shared currency doesn't truly integrate markets, what is the real price of abandoning your own money? Think about that for a second. It completely flips conventional wisdom right on its head. Thanks for watching.